I'm Kevin, and today I'm gonna do my analysis of financial performance, and I'm gonna analyze the company name already. First of all, I want to analyze the liquidity of this firm. I want to use two ratio, current ratio, and the quick ratio. About the current ratio of this company, I can tell that it is very constant. It's just at the level of 1.7, 1.69 about the 5 years from 2013 to 2017. Um, the quick ratio is increasing. It's growing in this from 0.41 to 0.67. So that it may have a trend to continue to grow in the next years as it is growing from 2013 to 2017. Here, another information about the liquidity I want to talk about is the revenue. Here you can see that from 2013 to 2017, the revenue is growing. Revenue is showing the receivable, all the receivable and the bank overdrafts. Next, to talk about the efficiency of this firm, I want to use two main ratios: is inventory turnover and the receivable turnover. Here we can see the inventory turnover is increasing, which the days for each inventory for each turnover increases, and amount of time turning over decreased by annually. Same with receivable turnover. I can see that they is slightly increased here, but it's decreasing very sharply here. It's same with the trend and number of time of turnovers in receivable. Cost of goods sold is also another point I want to point out here because firms compete in the fields of competitions in the market. They may offer cheaper price to get better customers, but here the firm offer a higher price. So I think that it's doing very well in marketing and differentiating the products. Here the cost of goods sold is increasing by the years from 2013 to 2017. It increased sharply. Next, I want to talk about the profitability, and this is the last topic for session for RIT. Here we can see that I use two main ratio is the return on assets and the profit margin. Uh, both ratio is very low. It's kept at low below 5. Here we can see two main difference, which is 7.95 and 26.68. These two peaks constant, so I don't think that many specialists will consider these two data. Talk about earning per share, since this is a way that firm is calling for resources, monetary resources, and it's a permanent resource. Since we can see that it's very low, it's below 0.5 in 5 years. So I don't think that it's doing very well in increasing the price of the share. It's still a permanent profit for firm. Uh, Here I want to analyze the three firms already WBA, CVS under the view of investor and long-term lenders. Um, the long-term lenders, they will focus on the liquidity of the firm, which is the firm's ability to pay debt. Wants to focus on the current ratio the most because I think it's the most significant point because they may consider the fully amount of firm's ability to pay debts. Here we can see that ID, the blue lines, has the highest ratio amongst them all. Both the orange line and the blue line is very low and increasing very sharply comparing to the blue one. Next, I want to talk about investor views on um, firms. The investors will focus on the profitability performance, which specifically is the net margin and the return on assets. Here we can see the return on assets of RAD is not as high as the BA and CVS tends to be blended, so they the same to the investors. The short-term lender, which wants to have the highest profitability, which they may take risk and invest for, or margin and return on assets here is very much the same. So you may look at one or the others to consider about these three firms. And that's all from me.